Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG14 amortization, varying amounts. Notes print. Leave a comment. Amortization, varying amounts. Adjustable rate mortgages, ARMs, are defined as a debt secured by real estate with an interest rate that may move up or down following a specified schedule or in accordance with the movements of a standard or index to which the interest rate is tied. Adjustable rate mortgages started up in the 1980s as another reaction against high interest rates. ARMs start at a lower initial rate than fixed rate mortgages. However, they can go up if key indicators, such as the cost of living, rise. They may have overall caps that they cannot exceed. For example, a 6% loan may have a cap of 10% it can never exceed that over the life of the loan. Some also have a yearly cap. For example, they could never increase more than 1% in any given year. End of page. Chapter start. 28%. 28%. Residential sales comparison and amortization, ARMs. Take a look at the chart below. In every year, the average rate for ARMs is less than for the fixed rate loans. In some years, such as in 2013, there was a wide spread between the rates. In other years, such as 2006, the spread was only about 1 point. Back in 1984, ARMs captured 61% of the market, whereas in 1998, they only accounted for 12% of the market. The market penetration depends on factors such as current interest rates, supply and demand and forecasts of future interest rates and actions of the Federal Reserve Board. End of page. Chapter start. 28%. 28%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG16 reverse annuity mortgages. Notes print. Leave a comment. Reverse annuity mortgages. Here's an example of a reverse annuity mortgage, which is more commonly known as a reverse mortgage. Your elderly Aunt Agnes has a large amount of equity in her home, which she paid off decades ago. But she has little or nothing to live on besides Social Security. She also does not want to sell her home to realize the equity in it. She might want to take out what is called a reverse mortgage. This is defined as a type of mortgage whereby age-qualified homeowners systematically borrow against the equity in their homes, receiving regular, usually monthly, payments from the lender. Borrowed funds and accrued interest come due when the last surviving borrower dies or permanently vacates the premises. Under current HUD guidelines, all of the mortgagors must be at least 62 years of age. When the loan is due, the estate usually has approximately 12 months to repay the balance of the reverse mortgage or sell the home to pay off the loan amount. All remaining equity is paid to the vacating homeowner or the estate. An FHA insurance program ensures that the vacating homeowner or estate is not liable if the loan balance exceeds the value of the home at the time the loan is due. Also called a reverse annuity mortgage or home equity conversion mortgage. Reverse mortgages have become quite popular in the United States. They can give older Americans greater financial security to supplement a fixed income, meet unexpected medical expenses, make home improvements, and more. Aunt Agnes might decide to borrow $100,000 for 20 years on her home, which is currently worth $200,000. Instead of getting the money all at once, she would receive it in monthly installments. When she dies, her house is sold and the remaining mortgage, plus any accrued interest, is paid off. Her estate receives the balance. Hopefully, her house will have appreciated since she took out the mortgage, possibly even at the same rate as her interest, or even higher, basically allowing her to live off the appreciation while she is still alive. End of page. Chapter start. 28%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG 17 points. Notes print. Leave a comment. Points. A point is 1% of the amount of a mortgage loan. Discount points are defined as a percentage of the loan amount that a lender charges a borrower for making a loan may represent a payment for services rendered in issuing a loan or additional interest to the lender payable in advance, also called points. Each discount point is 1% of the original loan amount. Points are also another example of creative financing that originated in the 1980s. The first time I heard of points was in regard to an FHA loan. Lenders started charging points, claiming that FHA loans were much more difficult and time-consuming to process, and therefore they needed to be compensated an additional processing fee. When interest rates ballooned in the 1980s in many states, they exceeded the usury limits that were on the books. For example, a state may have decreed that it was usurious to charge more than 10% interest. When lenders felt they could no longer make a profit lending money at 10%, they came up with a workaround. It works out mathematically that if you charge 10% interest for a mortgage loan and then charge 4 points up front, it averages out to give the lender a yield in the range of 10.5% over the life of loan. So, charging points became an accepted way to bump up the yield on conventional loans above the stated or face rate. End of page. Chapter start. 28%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG 18 sources of capital. Notes print. Leave a comment. Sources of capital. From the 1930s through the 1960s, banking was done primarily at the local level. If you wanted a mortgage, you went to the local bank or thrift and filed an application. A bank officer might drive by your house, and they would check your employment record. Decisions on lending were usually made by the board of directors or trustees of the lending institution at their weekly meeting. Formal appraising and underwriting, as we know it today, was not part of the process. After the closing, they would put the papers in a drawer and hold the mortgage in-house. The primary sources of mortgage capital in those days were state or federally chartered savings banks, savings and loans, commercial banks, credit unions. End of page. Chapter start. 28%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG 19 sources of capital. Notes print. Leave a comment. Sources of capital. Savings banks are either mutual or stockholder owned. Mutual savings banks are similar to savings and loans and invest large amounts of their depositors' money in residential mortgages. Around 1990, many mutual savings banks went public and converted into stockholder-owned institutions. Most savings and loan institutions were chartered primarily to provide residential mortgages for the local areas. Their purpose was to receive savings, loan money at interest, and distribute dividends to depositors. Commercial banks are privately owned institutions that were obviously oriented towards business loans, but dabbled in residential loans. Their interests were usually short-term, but they supplied loans for construction and development. Historically, credit unions primarily loaned only to their members. Later, many opened the door to all borrowers. End of page. Chapter start. 28%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG20 sources of capital. Notes print. Leave a comment. Sources of capital. Where did lenders get the money to lend out? In the old days, if banks wanted to loan out funds for mortgages, the sources were limited to depositors, sale of stock or shares of ownership in the bank or thrift, repayment of existing mortgages, borrowing of funds from the Federal Reserve. Lenders were regulated and had limits on the number of branches and had reserve requirements. If they had a deposit reserve requirement of 10% and were a $10 million bank, once they lent out $9 million, they were out of the lending business. They had to wait to replenish the money supply as money slowly trickled in from deposits and repayment of existing loans. Money could be borrowed from the Federal Reserve Bank if the rates were favorable. End of page. Chapter start.